Every great success starts with a dream, a desire to make something better. At Deluxe, we're driven by these dreamers, those determined to go out and do what it takes for their families and communities. It was that courageous spirit that drove our founder to invent the checkbook and change the modern payment system forever. Today, Deluxe brings that same commitment and determination to help our clients and our communities achieve their dreams. At Deluxe, we champion businesses, big and small, because successful businesses create jobs, strengthen communities, enrich lives. We do it for people like Wilma Fragoso, one of our millions of small business owners who needed help with her well-loved restaurant. Deluxe provided the brand and marketing and promo solutions that brought her business the attention it deserved.
Wow, this is all my dream.
We do it for more than 4,600 financial institutions. Through data-driven marketing, payment, and cloud-based solutions, Deluxe is helping these businesses strengthen their customers' trust while creating the future of financial services today. We do it for the nation's largest enterprises, from real estate and construction to healthcare, manufacturing, automotive, and retail. We leverage our expertise to help these businesses excel. And we do it by example. At Deluxe, we're shareholders with a personal stake in everything we do. Whether it's helping revitalize towns across the country through the small business revolution.
Hello, Cersei!
Supporting the work of the Deluxe Foundation, or volunteering thousands of hours to impact our own communities. Because when they do well, we all do well. Deluxe, champions for business, so communities thrive.
Hello, I'm John Yates, and I chair the technology practice at the law firm of Morris, Manning & Martin in Atlanta. And I'm pleased to be here today with three good friends and fellow panelists on a very interesting topic. Our title is Show Me Money, How to Tap SPACs, VCs, and Investors. And we're very pleased today to have with us Kathryn O'Day with Atlanta Ventures, Steve Debacco with Leaders Fund, and Phyllis Newhouse with Athena, a new SPAC. So many thanks to the three of you for being here today and for supporting TAG.
Great, thanks for having us, John.
Thanks for having us.
So let's start out, first of all, since we have sort of all three of the food groups when it comes to investors. We've got Kathryn in the earlier stage, Steve in the growth stage, and Phyllis is going to take us to the moon with the SPAC. So let's start out maybe with a brief description of your fund and also how you came about being a part of that fund. So Kathryn, why don't you start out? I think you're the newest entrant into the venture community. And so give us your background and tell us about Atlanta Ventures.
Sure. Atlanta Ventures invests in early stage subscription companies, primarily tech in the Southeast. And we also look to partner with potential entrepreneurs to start new companies. And my background has been Atlanta tech through and through. I was early at Pardot and then the COO at Rigor. So I love working with technology companies and scaling them.
It's great. Great to have you involved here. So Steve, give us a little bit of background on Leaders Fund and also how you became an investor coming from the operating world.
Sure thing, John. Again, thanks for having me. I'm one of the co-founders of Leaders Fund. Leaders Fund is on our second fund. We introduced Fund 1 in 2016 as a $100 million fund investing in B2B SaaS enterprise companies. And we just closed Fund 2, $150 million fund, again, focused primarily on B2B SaaS enterprise solutions. And prior to becoming an investor, I spent 20 years basically building companies from the ground up to over 100 million in recurring revenue, and had 6 nice exits. After the last exit, we decided to join the dark side and leverage all that experience we had and all the sweat equity we established over the years to leverage that and become investors and help entrepreneurs build great companies. So we're excited to be part of the Atlanta investor ecosystem, and we've been having a great time these past 5 years.
Thank you, Steve, and thanks for investing in the community. And Phyllis Newhouse. Phyllis, you are in one of the most exciting areas now with the SPAC. And you've also had significant background in the tech space. Tell us about what you're doing now and how you got there.
Well, so right now I'm leading one of the few women-led, all women-led SPACs. And our focus is in technology with a focus in cybersecurity and AI. We're a $250 million SPAC, looking to acquire a company between that 2 and 6 billion. And how did I end up in a SPAC was a couple of years ago, I started talking to SPACs myself for my company, which is a cybersecurity company, and looked at it as an alternative way to go into the public markets. And so as a result of that, a few of women that are also in tech and venture and private equity bankers, all of us decided to get together and launch a SPAC together and leverage all of our expertise to do the SPAC. So that's how I got here.
It's very interesting. Let me ask you, maybe to get for the benefit of the folks that are listening in here from the TAG Summit, they've heard a lot about SPACing and de-SPACing. Can you just give us a very, very quick primer on the SPAC, the special purpose acquisition company, and sort of what it is and where you're going from here?
Absolutely. So, and this is, I think, a lot of CEOs and founders that I've actually talked to in the last year and asked that question, would you go public? And do you know the ways that you can go public? And so a SPAC is simply a blank check company that goes public by way of raising capital. So we raised $250 million through institutional investors and investors, family offices. We raise the money, it goes into a trust, and then we list on one of the exchange. And then we have approximately 2 years from the date that we go public to find a company to merge into the SPAC. Then that company becomes a publicly traded company once the combination happens. So if you think of, and I say this to a lot of founders that we're talking to today, we're doing all the capital raise, all the money, and you're basically, as long as you're public ready, you will merge into that SPAC and then become a publicly traded company.
And I guess that merger process, I think, is called a de-SPAC.
That's the de-SPACing process. Yes. Yeah. So people ask, what happens to Athena once the company becomes public? Athena obviously goes away, and they merge into the SPAC, and then the new ticker, and that becomes a publicly traded company.
So let me ask Steve. I'm sorry. Go ahead. Excuse me, Phyllis.
Yeah, it's a very interesting process, and I think a lot of companies, SPACs have been around for a long time. But with the amount of capital that's in the market today, you're seeing a lot of these SPACs are getting larger and larger. And if you think of today, there's about over 500 plus SPACs out there in the market today.
Wow, great background. So let me ask Steve. Steve is investing in companies that maybe someday will be de-SPACed. In other words, they would merge into a SPAC. And Steve, tell us a little bit about the kind of companies you invest in, and also how people approach you to be able to get your attention. What is it that really captures your attention when a company comes to you that meets your profile?
Yeah, so times have changed since we started the first fund, John. So we continue to focus kind of on our primary fundamental thesis, which is find good companies that are solving real business problems, that have a great team in place and a large addressable market. So that's kind of the first set of criteria we use when we're looking at great companies to invest in. Really the founders, the market, the product, and the solution. So you look at our portfolio, and it includes companies that have primarily focused on solving real business problems. So that's kind of really what we look for. We find entrepreneurs through various number of ways. We have technology that we leverage to find companies that are growing quickly. We leverage our network of previous investors, and we leverage our network of portfolio CEOs that we have that have either had a nice exit or are just part of an ecosystem that we feel very comfortable with. So that's kind of what we're doing in terms of where we're investing. We had a thesis around doing Series A and Series B investing. And then as the valuations have been skyrocketing these past few years, we're starting to look at getting into opportunities earlier where the valuations make a little more sense. And so we're doing some Series seed investing now, and then we continue to do A and B investing as well.
So what does that mean? What's the smallest check that you probably be thinking about writing, Steve, in this current environment?
So we've done checks just a little under $1 million for seed investments. Our goal is really to get a meaningful stake in a company, because when we invest, we like to, like I said, leverage our previous operating experience. So if we can't get a meaningful stake, and by meaningful, I mean anywhere from 5 to 15% ownership, it really doesn't make it worth our while. So if we invest $1 million and we get a very small piece of a company and we get a 10x return, that really doesn't move the needle on the fund. So we want to invest with not only a short-term perspective on percent ownership, but the ability to increase our ownership over time or increase our dollars invested over time. So we may start out with $1 million investment, but we'd like to get 10 to 15 million into a portfolio company over the duration of the investment.
Very interesting. So if you're writing a sub-$1 million check, potentially, you know, you've got Leaders Fund, Kathryn, that's sort of invading in your territory here, going down the food chain. You know, you won't have to worry about Phyllis up there because she's got the big bucks right now, but you got people like Debacco out there, you know, who are sitting there saying, competing with you. Tell us a little bit about what you're looking to invest in. And I got to imagine that the aperture is really big. You must see a boatload of companies, and be interesting to tell our audience how you slim it down to those best few.
Yeah, that's a great question. And I will talk a little bit more about how Steve and we may not actually be competing that much. But so what we look for is the right entrepreneur, somebody who has grit. If they've done it before, we love that. So if you've started something and it hasn't worked out, we're actually looking for that. So don't be deterred. And then we're looking for authentic demand. And that highlights that there's a problem that people want really, like they need it solved really badly, and they're going to pay for it. So when we're talking to companies, we say, you know, how many passionate paying customers do you have? And even when it's early, you should have at least 10 customers who have to have your product and they're not related to you. So that's what we look for early. And it's interesting because with the current market, competitive, lots of capital, you know, we are still totally focused on that seed stage. So like 250K to $1 million is our sweet spot, but there are times when we'll go a little bit up market because that's like the valuations are driving us there.
Very interesting. So Phyllis, let me shift over to you a second. One of the areas that's a hot area, you talked about cybersecurity, and now you're sitting here a little bit like Steve and Kathryn. You know, you're sitting on a pile of money, or you will be sitting on a pile of money if you're not already. But a little unlike Kathryn and Steve, you've got, I think, what you said, 2 years in which to go find basically a partner. Is that right?
Yeah, we have 2 years, but you know, when we started the SPAC or started the formation of the SPAC, we were very, very strategic in developing a proprietary pipeline before we did the SPAC. And I got asked this question a lot. There's a lot of SPACs out there, and everybody's hunting and chasing down those targets within that sweet spot. Because if you look at the size target we're looking for, I mean, you don't have a lot of companies out there just sitting around the 6 billion. So, and then you've got 500 plus SPACs out there. So we were very strategic in looking at the sized target, but also leveraging the relationships in the SPAC. But what we found is that bringing strategic partners in early and building that proprietary pipeline so that day one, when we hit the ground running, we don't anticipate using up 2 years. We didn't go out with 200 targets on a list. We wanted to make sure we narrowed that down and was laser focused on the targets that we were looking for within that size and sector, and that we had proximity with the relationships of those targets. So that's kind of, and so if people say, well, Athena be announcing a deal pretty soon. Well, I sure as hell hope so. I don't hope that we are going to be down to the 2 year mark. So I call us the special forces of SPACs. So we're super excited about what we're doing.
Well, it's very interesting. And you highlight a very important point about what I think the way SPACs have sort of fallen into two categories. One is the group like you that have really thought through in advance and have a, sort of proprietary list of folks. Tell us a little bit about your partners in your SPAC, because I believe it's, as you said, I think it's primarily all women and all very experienced. Just give us a little background on who they are.
Yeah, I would tell you, John, this was an amazing journey putting this team together. When we looked at our board of directors, we wanted women who had been the first billion-dollar company, first woman ever to take a company public, first SEC woman, first woman of Ivy League University, first woman to ever sell a company for over $1 billion. And then when you look at our advisory team, our management team, the management team along, you have founders, operators, value creators, you have women that have run major funds right now, cybersecurity funds. We got women that have been in private equity and banking and investment banking, running institutional funds. And so we span across the industry, but the expertise is just insane. And so when we were putting this together, we really thought through, when we put this proprietary team relationships together that we have and the deal flow, we wanted to make sure again that we could leverage the expertise with all of the women that's in the SPAC. And so people ask, why do we do all women? Because when we looked at the market and assessed the market, we didn't see any SPACs that were led by women at all. And certainly I was the first woman of color to, this is astonishing. I found out as I was going through the SPAC process and formation that in the history of the exchange, there's only been 21 women to take companies public, and not one had been a woman of color. So I was the first woman of color to ring the bell on March 19th and to take a company public. So that was exciting. So I think we built one hell of a team, and I call them all rock stars. That's why we were eager to hit the ground running.
Well, you really trailblazed there, Phyllis, and which is exciting. It'll be exciting to see that journey as you're out there finding an opportunity and finding a partner company, so to speak. So let me pick up on that thought maybe with Kathryn a little bit. Kathryn, you're a little bit more of a newcomer, so to speak, to the market. And I'm wondering, when it comes to companies that come to you, and they're going to say, look, Kathryn's a very smart person. She knows that she's got a lot on the ball, but what is it she's going to give me in addition to the money? And I'm going to ask Steve this too, but what is it you're going to give to them other than capital? And they may say, look, Kathryn has been around for a while, but she hadn't been around that long. So where's that value add? What are we going to get in addition to this dough that she's going to give us? So what's the answer, Kathryn?
Yeah, so everybody says they're entrepreneurial, friendly, and focused. Everybody,
but you really are, right? You really are.
But I really am this time. So here's what you get with the Atlanta Ventures team. Everybody's an entrepreneur, including we still are starting companies in our own portfolio. That's our passion. So that's all we do. We're super fast. We're small, we're scrappy. We go at a startup pace, and people love that. The last piece I think also is who we are, which is focused on the entrepreneur, the genuine, like authentic. We're, understand the new technologies. And so I think people, like entrepreneurs who are starting, they appreciate the candor and maybe some of the freshness.
So how much hands-on do you have in that regard? Let's just say that you're an entrepreneur, you think about raising money. One day you want to have a company big enough that Phyllis's SPAC is going to want to de-SPAC me. But right now I need the connections with Kathryn, and I may say, look, I need the David Cummings contact too. I need to be able to get connected to these folks. I mean, how much hands-on am I going to have there, do you think, and how much hands-on do you think an early stage fund like yours can provide to companies?
So we are as hands-on as you want us to be. And I think that goes to letting the entrepreneur run the show. You can see with Sales Loft is an interesting example. Like Kyle loves to go big, raised a ton of money. Now they're a unicorn. Taupe at Calendly is another interesting example because they were bootstrapped all the way through, low key, low profile. And then Rigor, my former company, is another interesting example with no outside capital, smaller exit, but exactly what the entrepreneur wanted. So I think that's an example of like, however you want to do it, we want to support you. And then in terms of like a specific, like you send us an email, we reply back right away. We sent an intro to a CEO that got a sales deal done this past week. So those are like very specific things, but I would say generally we are available, but we'll never tell you what to do.
That's a good answer. So Steve, let me ask you now, Steve, you have a background that you didn't talk much about this, but I know from experience that you have also been responsible for sales. I mean, you have had a quota, you've been in the boardroom, probably a lot like you, Phyllis and Kathryn, you two, where you got board members pounding on you saying, you know, why aren't we meeting these numbers? So you've sort of seen that. How important is that now in your equation when you're looking at companies trying to figure out what that first board meeting is going to be like, or maybe the second board meeting after you get through the honeymoon? Do you really dig into those numbers? And is that something that you are particularly adept at doing, looking at the forecast, seeing how realistic it is and who it is that's going to actually be sweating those numbers?
Great question, John. I'm glad that I can take all the pressure that was put on me over 20 years and place that on somebody else. So it's a nice feeling. But no, to be honest, we actually start from day one when we look at investing in a company to help them kind of set the proper infrastructure for a go-to-market strategy and help teams set the proper foundation so that when they build the sales organization and they put together the metrics they need to look at on a regular basis, you know, all that is ingrained from kind of the beginning of the company. So when we get to the point of having formal board meetings, you know, the expectations are set. We want to look at certain metrics. We want to dive into key areas. If it's more of an enterprise focused company, we will dive into the pipeline and talk about specific cornerstone deals that may be instrumental in helping, you know, increase the value of a company. If it's more of an SMB mid-market focused company, you know, we'll put the proper tools in place to make sure they're looking at the metrics and getting reports on a daily or a weekly basis so we can see kind of the trends and make sure we have an understanding of potential issues around churn possibly before they actually occur. So yeah, the board meetings are more of just diving into some of the details. We expect to get the reports in advance so we can kind of go through those numbers in advance, and then we'll dive into specific areas that we may see are either concerning or where we can provide help and add value.
You know, it's interesting. I tell all of our clients, you know, the tech area, to think of the board meeting as a performance review, because it's one of the few times that, you know, people like the three of you are really in the room with these companies, but, you know, you have the tough questions to ask. So one of the tough questions that we're seeing, and Kathryn, maybe you can address this, and Phyllis, I'm sure you're thinking about this as you're looking at companies out there, is the talent issue. And right now in Georgia particularly, you know, we have Microsoft, we have Google, we have other companies coming to town, and all these are really positive, you know, factors to the community. It means a lot of talent's going to get pulled in. And so the questions might be in that situation, look, is it going to be more challenging in Atlanta for startup companies to be able to pull the talent in? And Kathryn, you're out there working with startups, early stage companies, but they're not competing with, you know, the NCRs and the Googles and the Microsofts and everybody else that's coming to town. Is that going to make it more difficult for you? And when you're sitting around the boardroom trying to fill these spots, is it going to be more challenging?
It's a great question. And I think it's going to be easier. And here's why. Because the people who want to do startups are not necessarily the people at a Microsoft. But what happens is that Microsoft and I hope they don't hear this because they're going to hear my strategy, but they're going to bring in the talent. They're going to bring them here. They're going to come here, and then they're going to say, actually, this has been great experience, but I want to do it myself, or I want to go smaller. And so my experience has been that there's rarely head-to-head competition. And so I think growing Atlanta as a tech ecosystem and a place where there's awesome tech jobs, I think we'll actually all win. And I'm not worried about it, but talk to me in a few years.
Yeah. Phyllis, what about from your standpoint? You're out there now looking, you're going to be looking at companies. I mean, it seems like a lot of folks from the West Coast came to the East Coast, came into Atlanta, and we're still trying to attract folks here. with the idea being that it's easier to find, talent here, it's less expensive. When you're out there looking at companies now, how do you look at the Atlanta market and the Georgia market? And do you think we still have the attractiveness to bring the talent here, but also to bring the companies here?
Yeah, I absolutely. So I'll speak to that from two perspectives. As a cyber company headquartered here, I definitely know that because we've got a lot of outside talent that I've actually had to bring here. And so also too, we have a different way of developing talent. The way we do it, we don't do job interviews, we do job pitches. You come in and pitch an idea and an innovation, and you come in. And so we don't hire people based off a resume, but based off of their actual pitch of the solutions that they want to bring to the table. And so when you get somebody that leaves Google who has really thought about some innovation, but may not have been able to get it launched at Google, they come to Xtreme Solutions, and now we're launching a new product so that's why we don't do job interviews. So I'll tell you from the SPAC perspective, the company sizes that we're looking at, obviously these companies have to have a level of public readiness. And so we're looking at management teams, we're looking at their workforce, we're looking at, do they have the sustainability, the retention? There's a whole lot of metrics that we're in the public readiness due diligence that we're looking for a company that can go public. And so when you look at that, so whether it's a tech company in the AI or direct to consumer, those are very, very critical when you start talking about now being able to scale at a rapid rate once you go public. So you almost have to have a team or a well-developed team. And I do believe, looking at potential targets here in Atlanta, we believe that the talent is here, and certainly those companies that are SPACable that could go through a SPAC.
Good point. It's whole new vocabulary and terminology here.
Listen, when people call me up, they said, John, folks call me up. They said, "What are you doing?" I said, "I'm SPACing right now. You have to call me later." So even my family is now picking up the lingo.
Well, you have a high level of SPACability there, Phyllis, which is a good thing. So it's so speaking of SPACability, it comes into valuation too. And Steve, let me ask you this question. You highlighted earlier a phenomenon that we're seeing, which makes a lot of sense, which is you may have to go a little bit further downstream than you did before, but you then need to be able to get enough capital in the company to get the return. Is it becoming more competitive, and our valuations, in a level of frothiness at this point? Do you think they're going to stay there for a while?
So yeah, everybody describes the market as extremely frothy. We're looking for companies that, have actually either created enough value to justify the prices that they're getting. But what we're seeing also is that when we've invested at the seed stage, and help the company get to a few million in ARR and expecting to do, the A round or lead the A round, you get the big guys coming in, that are writing, $25 million checks on 100 million pre-money valuation for companies that are doing a couple million in ARR. And it's just crazy. So that's the way the market is today. And to put money to work, it's very, very challenging and competitive. And one thing we have to be cognizant of and make sure we don't get wrapped up in is, buying into this run up in valuations, because at some point, these companies are going to have to justify the valuations they're getting. And the last thing we want to see is a flat round or down round. So, we have to make the choice, when we do a seed deal and then the A round comes around, are we gonna take our pro rata? Are we gonna try to lead the A round, which oftentimes we can't write a big enough check, or are we gonna exit the deal? I mean, because we're seeing the compression in the timetables of raising a seed to an A, where it used to be, sometimes 18 to 24 months. It's now sometimes 9 to 12 months. So that funding cycle is getting compressed, and we can see a tremendous return very quickly. So we've actually exited, 2 deals where the A round was just so valuable, we could get a quick return on our money in 12 months. So we're balancing all this out. And, you know, at some point, the valuations will come down to reality, I think, and I'm hoping. But, you know, I said that about the stock market a few years ago and about, you know, Bitcoin as well. Things just keep going. So, you know, it's a challenge for us to find good deals. And it's getting very competitive out there. And, you know, valuations, I think, have doubled over the last 12 to 18 months. You know, we're seeing, you know, before we saw $100 million valuations on companies that were doing 5 million ARR with, you know, projected 12-month ARR, you know, around $10 million. So they're about a 10x on forward ARR. And now we're seeing, you know, 20 to 25 times. So valuations are crazy. We're hoping that they'll come back to reality, but if not, we're hoping to get in earlier and, you know, make a quick return.
Very interesting. So I'm going to ask Phyllis and Kathryn a question about women in technology and women in technology and women of color in technology. There's much more of a focus in that area now than I think any of us have ever seen, which is great. It also is a challenge, though, right? To find women in technology who can fill certain spots. You really got to be, I think, intentional about going in and trying to seek these folks that are really interested in these positions. How do you go about doing it? Phyllis, you guys have put together a great team. Kathryn, you as well. How do you factor that into the equation with regard to the fact that you're also a capitalist? So you got to make money, you know, you got to get the return on investment, but you want to also have diversity within the company. A lot of businesses, I think, have that challenge. And, you know, I think y'all have been probably successful, especially you, Phyllis, being able to address that. How should companies be thinking about that if they say, I want to have a diverse executive team, but I also have got to make sure that I got the right return on my investment of the right people in there?
Yeah, so I'll use this. So let me just start with my company first. I think when you are intentional about it, it happens, right? And when you can just say to your board or anyone for that matter, it's just not okay not to be diverse. It's just not, right? So that's my statement up front, regardless whether I'm on a couple of public boards now. And that was my statement the day I joined the board. It's just not okay not to have the diversity on this board. But more importantly, I'll tell you, as we are looking at target companies and we're talking to founders out there, the first thing we do look at is diversity. And we look at, and these are some very big tech companies, but here's the value that this SPAC brings to the table. The day we assembled this team, we were very intentional about diversity. So if you look at our SPAC, from a perspective of, Latino, Asian, African-American, we probably have the most diverse SPAC out of all the SPACs that are on the market right now. So if any company, and here's the value add when we're talking to founders, we can look at that board, we can look at that management team, and we can say to them, we're going to help you with this problem that you have. In order for you to go public and for us to combine together, there has to be an alignment with our values. And our values say that this is not indicative of how the world looks, and we don't want this company to look like this, and we believe that we can help you with that problem. And what we found when we were raising capital, I will tell you this, when we started talking to institutional investors, they were blown away at the team that we had put together because of that. So we had a lot of institutional investors that were in day one when they saw what we were building and knew that we were going to add value. So if you think about NASDAQ, if you list out on the NASDAQ, you have to have that on your board to go public on that exchange. That was as of November. So a lot of companies are struggling with that. And so I believe that if you're intentional about it, it becomes part of your culture, and it becomes part of your overall strategy.
Good point. Good point. And Kathryn, what about from your perspective? You're seeing lots of different companies. How intentional is it in your analysis?
Yeah. So the more diverse the leadership team, the better the company performs. There's research out there that proves that. So it's something that we're always looking for. Something about diversity that's interesting is it takes some to get some, in that, you kind of like people see like people see other people like them, and that attracts them, and they know that that's a safe place for them. But so how do you get the early diversity in your company or in your fund? And so just some stories in case it's helpful to somebody. When I started day one at a company, I had the male CEO forward an email to me of an article about the culture on Wall Street and how it's like a good old boys club and all the things that happen that are not friendly to women. And he said, hey, if we ever do anything like this at our company, please let me know. And so that immediately opens the channel of communication that you can bring up any issues that have ever happened. And then there were a few times that I was like, hey, this happened, like, let's deal with it. And then another more recent example is before I started at Atlanta Ventures, we have 2 small children, no daycare because of the pandemic. And so, when David Cummings and I were talking about start date, I asked if I could push it out a few months so that our kids wouldn't just be roaming the neighborhood. And he said, yes, no problem. And so I think the kind of flexibility around, that's kind of female specific, but parents in general, around things like that, just make it like you play the long game on things like that. So that's another example that I like to share of how to get it started if you don't yet have it.
It's a great point. I think the other element of that is that, parenting now is a 2-parent responsibility many times. And so, the husband or the other spouse has to oftentimes be involved in this equation. So I think companies need to be appreciative of that. It's not always just the woman, and maybe
right.
the other spouse that's going to have to be involved.
Yeah.
So good points.
One of the best ways to encourage women to stay in the workplace is to offer paternity leave.
I believe it.
But I also think one of the ways to keep them to stay is to give them opportunities, because a lot of times when opportunities are not met at the door, I always say, in my workplace, we call it the rock. When the moment that somebody walks to that door, hand them a rock, and what that rock is resources, opportunities, and a connection. Because that one of those things could make a difference in the lives of those people that are coming in that workplace every day. People listen, I found out in my culture, especially the younger generation, they do not check mores at the front door. And so if you're not thinking about how to be intentional about diversity and it's not embedded in that culture, then you as a CEO are addressing many issues today that we weren't addressing 10 years ago. And so I think it's critically important that diversity, it's just not just the word diversity, it needs just to be embedded in the culture.
So I'm going to ask another question in just a second as we begin to close this, and I'm going to go ahead and tell you what it is now, but I'm going to say, if you had to pick one area that you are really interested in right now, let's say ed tech or, space law or whatever the heck it might be, just think about what that is, because we're going to end on that note. But before we go there, I want to ask Steve, maybe picking up on the comments that y'all are making, what's sort of the red flag that you're looking for, Steve? I mean, I think it's, if you were talking to a management team or you're talking to a prospective, portfolio company, are there one or two points that you would say really are going to be important for you to focus on, and that would be major red flags for you?
Gosh, John, all these startups have the best PowerPoint presentations and everything's kind of a bed of roses. I mean, things look great and we want to invest in them all, right? We get these great presentations and, there's a lot of great entrepreneurs who are solving a lot of great problems. But yeah, when we start looking at opportunities, everybody talks about kind of the same criteria. And the one that, we can't ever get away from is the team. The team that is building the company is critical. So we look at that very carefully. We, meet the team, we do background checks on the team, we talk to people that have worked with them previously, and we really do a lot of homework on the team. And it's amazing some of the things we find out and some of the things that aren't exposed to us about the team when we're doing our analysis. But that's the most important. And so it's not only the team that founded the company. We were at dinner one time with the founding team, and two co-founders got in an argument at the dinner table, and we're like, oh my gosh, this is foreshadowing of what's going to happen in the future. So we actually walked from the deal because we don't invest in deals we're going to change out the team. But it turned out that they got rid of the CEO and they got to unicorn status. But you know, that's kind of the anti-portfolio. But so the team is important, you know, the founding team. But when we talk about team, we also talk about the ecosystem they've surrounded themselves with as being part of the team. So their investors are part of the team. So we also look at, you know, their current investors, and that's very important to make sure there's synergy between our fund and the previous investors or the investors that may come in. We've actually, you know, have been part of deals where we don't see eye to eye with some of the other investors, and it makes for a lot of work and more challenges than we saw coming. But so that, and the third piece of the team is kind of the other partners they have around the table, their advisors and things like that. So, you know, holistically, we call it the team, but it's got really three components. But those are the areas we really dive into and look for red flags.
Those are good points. So let's just real quickly, maybe starting with you, Phyllis, if you were thinking about one area, and maybe this is already something you've talked about in light of your SPAC, but an area you think is really, you know, hot area of focus that you're concentrating on. You mentioned cybersecurity. I don't know if that's the area, but what would it be right now? And what would you sort of tell entrepreneurs to be focusing on too?
Yeah, so if I had to say an area, you know, if you look at all the SPACs out there, over 500 plus, there's only about three cybersecurity, three SPACs that are focusing on cybersecurity. And I'll tell you what I found is that when we put the SPAC together, we were very strategic about who was coming into the SPAC. We wanted people that had the cyber background. We wanted people that had the AI background. And so when we look at the market, there's a reason there's only three SPACs, because what we found is that founders like to talk to founders. And so you can bring the bankers in, you can bring all these folks in, but at the end of the day, a founder would talk to a founder, and you have ability to really understand their technical capabilities from day one because of the team that you put together. And so what I would say is, like, if you're a cyber company or you are provide a cyber product or a major cyber solution out there, you know, these are the type of companies that you're going to probably see more cyber SPACs come out, with more people who are in the industry leading these SPACs or on the advisory teams.
Great point. So Kathryn, what about you? What are you looking for? What are some areas that are really hot for you?
Yeah, so it's always hot where there's a lot of pain. And what I mean by that is anything that's legacy, major pain points for people, everybody's complaining about, like, those are the areas, and there's lots of them. But I will say some specific focuses always for us are B2B SaaS, healthcare tech, and then kind of, I would say, like the climate ecosystem. There's a lot of pieces of that, but we are not trending in the right direction on the climate front, and we need to make changes now. And tech changes are like, we'd love to start there.
Great. Finally, Steve, what about you? What areas are you interested in?
So we're looking for areas that, you know, either disruption or a paradigm shift hasn't occurred yet. And, you know, we're diving in and are very bullish in the insurtech space. I know over the past few years, there's been, you know, I guess it's been an ultra hot sector, but for certain areas in the insurance tech space, there hasn't been, you know, a lot of AI, I want to say AI enabled risk, you know, management tools and broker platforms that are disrupting kind of the standard broker client experience. So we see a lot of opportunity in insurtech space, and are looking at a few opportunities there right now.
Listen, great insights here. Phyllis, Kathryn, Steve, thank you very much. I think this is going to be extremely informative for the entrepreneurs listening. We're very appreciative of the chance to be involved with the TAG Summit. I want to thank particularly Larry Williams, head of TAG, and the great job he does, and the board there, but particularly thank you folks for being supportive of this community and being supportive of technology in Georgia. So have a great evening, have a great summit, and thanks for everything you're doing for our community.